Welcome, ladies and gentlemen, from me, Guy Munson, to our regular 6-minute strategy summary. World asset markets continue to decline this month in the face of aggressive US rate rises and the rolling energy crisis in Europe. What markets had not anticipated, though, was a wholly self-inflicted crisis in a G7 member. Not only did last week's UK mini-budget set fiscal policy wholly at odds with monetary policy and UK inflation objectives, but the deliberate absence of a proper fiscal framework or any independent review was simply unforgivable. After all, the Chancellor announced the largest set of tax cuts at around 1.8% of GDP since Edward Heath was Prime Minister, with no analysis of how to fund it or any assessment of its long-term economic impact. Unprecedented volatility in the gilt markets, record lows in sterling, stinging international criticism, and surging mortgage costs, culminating in massive BOE intervention, has been the fallout in just a few days. In the slides ahead, we will look at what permanent damage this has done to the UK economy, what opportunities it may have created, albeit inadvertently, and what this means for your investment policy. So let's begin with our regular review of asset class returns for the year to date in the left-hand panel, and I'm afraid here the news is still not good. Gold down 10%, global equities and UK gilts down 25%, Nasdaq down 30%, and high-risk assets like Bitcoin down almost 60%. The culprit is easy to see, the steady drumbeat higher of US interest rates to 3.25% today. On the right-hand panel, you can see this is pushing up US 10-year Treasury yields, which is lifting bond yields around the world and putting downward pressure on asset prices. It's also driving the dollar ever higher, which is putting huge pressure on weaker international economies. To this problematic backdrop, we must now add the UK mini-budget last Friday and the financial crisis that engulfed the UK in the days that followed. It was not just the scale of the Chancellor's cuts that worried markets, although these were large enough. In the left-hand panel, I've shown the giveaways in terms of tax cuts or tax increases for UK budgets going back to 1972, and this was the largest giveaway since the Barber budget. But it was the rush delivery and scant oversight that really worried markets. No independent assessment by the OBR, no long-term plan from the UK Treasury showing the impact on the underlying economy or funding. The IMF was particularly stinging, unusual for a comment on a G7 economic plan, saying it's important that fiscal policy does not work at cross purposes to monetary policy. And the City's opinion was probably best summed up by veteran Lord Jim O'Neill, who described the whole approach of the budget as cavalier and naive. Some have compared the tax cuts to Mrs Thatcher, but I don't think that's quite fair. She sequenced them very differently. Yes, she came to power in 1979 and cut the top rate from 83 to 60%, but she also lifted the VAT rate from 8 to 15%, an overall tightening of policy. She tightened again in 1983 with the national insurance rise, and it was only in 1988 that Nigel Lawson cut rates significantly in a giveaway budget from 60 to 40%. Interesting though, he did that only once the budget had returned to balance. He was running a 1.5% of GDP surplus. This couldn't be more different from Kwasi Kwarteng's budget, where he's cut immediately in very big scale on taking over as the new administration, while the budget deficit is still minus 5% of GDP. So what does this mean for UK funding costs? Well, I'm afraid it's very bad news. You can see the surge in gilt yields in the left-hand panel. It was the biggest move upward in yields in a single month ever recorded. It's pushed the pound down at one point touching 103, a record low, rallying now to somewhere around 107. In the longer term, though, it's the pressure on the mortgage market that worries me. The Halifax standard rate has risen now to 5.24%, and John Charcoal, one of the country's biggest mortgage brokers, suggests that it's going to be very difficult to find any deals under 5%. So is value appearing in any UK assets? Well, the answer is perhaps. First of all, the yield on inflation-linked bonds has risen very significantly, touching at one point higher than 1% real yield going forwards. That's potentially attractive for long-term inflation plus accounts, which we have here at Saracen. On the right-hand panel too, it's also pushed up the yield dramatically for sterling corporate bonds, touching 6.55%. That's quite attractive against what we think will be an underlying medium-term inflation rate in the UK after the crisis of somewhere around 3%. So again, we're looking there. Let's consider too sterling at these very low levels. Well, at 107, we're about 25% away from fair value. That's as calculated by the purchasing parity rate, which is an internationally accepted fair value rate for global currencies. You can see that blue bar, the difference between the two, only going lower once. That was in the Plaza Accord of 1984-5, when the dollar value was being brought down by global intervention and a massive cross-border program of currency buying. We're not quite at super low levels yet. I think unless we see a policy change by the government, that pound could go a little lower. But we're beginning to see convincing long-term value. So what do we say in conclusion? Well, on the global environment, our message is still clear. Don't bet against the Fed yet. We're underweight bonds and we're underweight equities. From the UK perspective, we're still not ready to move on sterling, as I indicated earlier. We are making tentative moves into these highly attractively yielding corporate bonds and potentially index linked. In the alternatives, we're a little bit more cautious. Infrastructure and renewables, a key part of our strategy, will be more challenged under a higher discount rate. And finally, we're taking a lot of this money that we've taken off the table into a tactical and defensive position in cash. So I hope this is helpful. Thank you.